For most investors, bonds were traditionally thought of as the boring, safe part of the portfolio. But 2022 happened where both global shares and core bond markets sold off together in one of the worst years on record for balanced investors. Fast forward to today, with Japan's long-term bond market wobbling, people are quietly asking if government debt and even our currencies are as rock solid as we've always been told. So are bonds really back? Or are we all just still whistling past the graveyard right before the next big financial calamity? To unpack what bonds actually are, how they work in a world of rising long-term yields, and whether the next crisis could start in the bond market, I'm joined by Harbor Asset Management co-CEO Chris Wilson. If you enjoy this one, please give it a like, subscribe to the channel while you're here, and offer up your point of view in terms of whether bonds are safe or risky in the new world. Let's get started. With bonds in particular, it kind of feels like the unsexy thing to kind of get into and to allocate to when you're a self-directed investor. So I thought, well, rather than just cover things that people are interested in, every now and then I want to cover things that people probably need to know. And so just at a really, really high level, if you can give me a really simple analogy, what is a bond?
Yeah, look, I mean, at the simplest level, a bond is an offer to lend someone some money, and they'll return that money to you. And so, if you think of a really simple bond, I'm going to give you some money. You're going to pay me some interest on the way through, and then in 5 years' time, you're going to give me that money back in a 5-year bond. Using that property analogy, think about it the other way, where the bank's lending you some money. Unfortunately, you do have to give that money back at the end, but they're lending you that money. You've got an interest rate that applies to that money. You pay that interest on a regular basis. And at the end of the period, and that could be the end of your 2-year fixed period, you're effectively repaying that loan. Often you're doing it by refinancing and rolling that term, but actually bonds often do that as well. At maturity, the company who's borrowed that money will issue a new set of bonds to borrow the money for a bit longer. So effectively, they're creating capital to use within their business by borrowing that money. And then they'll refinance at that end of that period as opposed to paying it all off at time. So really simply, you're lending money to someone. They tend to pay you interest for the use of that money. And then at the end of the period that you've lent them the money, they return the money.
Yeah, in a perfect world.
In a perfect world.
And luckily, we live in a perfect world, don't we, Chris?
Well, we live in New Zealand. And so, look, the number of sort of corporate bond defaults are incredibly low in New Zealand. But, if you think of bond as a corporate example of lending some money, you could think of the same way of actually if I lent you money for a fixed period and at the end of the period you didn't pay it back, you'd be a bit of a credit risk.
That's right. And so just a little bit of historical context in the distant past, 60-40 portfolio, 60% equities, 40% bonds or fixed interest or income. That's kind of like your typical balanced portfolio, right? But in 2022, we saw like an interesting period of time, 2022, where interest rates had increased significantly and the value of bonds basically just went down.
Yep.
So can you speak to that a little bit and maybe just explain the relationship between interest rates in the market and bond values?
Sort of comes back to that first question of, well, how do you value a bond? And so back to that statement of, look, I've lent you some money and you're paying the money back. The way to think about it is I'm really valuing the present value of all of those cash flows. So, the cash flow of you giving me the money back, the cash flow of all of those interest rates, that effectively reflects the price of a bond. So how that changes, to use that extreme example, is if the day I issue the bond and you're going to give me, say, a 5% rate on that bond on an ongoing basis, if the interest rates then change on day 2, actually the value of those cash flows is going to change. And so if interest rates go up significantly, well, actually the value of the money you're giving me has gone down. And so the price has fallen. And so you've got this thing where it's the opposite. And so as interest rates rise, the price of your bonds go down. Mm-hmm. And so that's why, when you look at things of the long term, you talk about, a really positive period for bonds over an incredibly long time, over a number of years. That has been from really high rates in the 70s and 80s to these low rates that we saw through COVID when QE really came into low and we had effectively zero rates. And nothing is forever investing. And every time I hear there's a new paradigm, I always get a little bit worried. But you heard this thing, are we zero forever? Are rates ever going to rise? Effectively they have now. We're starting to see that. That was always a conversation with Japan where rates were incredibly low for a very long time and it's almost deflationary state for an incredibly long time. But that's actually started to see life and the long-term yields in Japan, which can have a flow through into markets, which when it's not expected.
Just thinking in terms of the relationship between interest rates and the actual value of the instrument itself, I often will look at it in terms of property. In Auckland in particular, we've seen almost 25% come off of property values within the last 3 years in terms of the median house prices, which is insane. That's before you even factor in inflation. So it can be quite extreme, these shifts in valuations just because of a minor shift in direction, right? Of these yields. And if we think about just like traditionally why investors would hold bonds within a portfolio, that might include exposure to property, infrastructure, and equities, and all sorts of other things. What role do bonds, or what role have bonds traditionally played in the past?
Look, have it traditionally in the past and still do. I think, but I don't think we're at the point of calling the end or the death of the 60-40 portfolio. I mean, there was obviously the period where, those two asset classes did correlate. But look, there's been a huge number of shocks over the years where they have performed in different ways, which is, again, why you tend to hold them in that classic balanced portfolio. Bonds are a bit more defensive. You expect that capital preservation, the return of capital at the end of holding them, that correlation benefit where they tend to move in the opposite direction to equities. And then actually you've got that stable income stream as well, which people receive into the portfolios. And so those things together is the role of those bonds within portfolio.
Right. Produce some income, create a bit of stability.
Create a bit of stability, and then that diversification benefit of doing, tending to do the opposite thing to the equities within the portfolio. So again, as interest rates fall, that could tend to be positive for your bond portfolio. Interest rates tend to be falling because things aren't looking as good from an outlook perspective.
Interest rates are higher now. So it's kind of like it's a coiled spring, right? If those interest rates fall, then we know the bond values go up. Unlike equities, which have growth, which is more or less infinite, potentially, bonds have to, by design, have a finite return, right? Because over a long enough time frame, if interest rates eventually go to zero and then they just stay there, for argument's sake, then there's no more returns to be had, apart from purely just the income that you can derive from it. There can't be any gains.
Well, right? But if the interest rate is zero, in a perfectly priced market, you're actually not getting any return on that capital. And so that was the interesting thing when you looked at rates going to negative. You ended up in this position where
you're paying for protection.
You're paying to basically get your capital back in 5 years' time. Effectively, you're paying them money to give you your money back in X number of years. And so the reason that can exist is market dynamics actually is if I have to own that bond or if I have to buy that thing and the value's gone down there, actually I'll accept the fact that I'm not getting a return on that asset because I have to own it. And so that's where you get these market dynamics, which can drive things as well. It's probably worth touching on, interest rates are one thing that impact the price of bonds, but there's a couple of other things in play as well.
Let's do that. And maybe credit risk to start with.
So if you start with that concept of, you're lending someone money, use that framework. And so there's a couple of things at play. There's, how long are you lending the money for? How likely are you to repay? And so again, you think about that concept of, I'm lending you money, or I'm lending Darcy Limited, is issued a bond. Effectively, I'm looking at you, and credit risk is really what's the likelihood of you repaying that money. At the most extreme end, that is, are you going to not be able to repay that money at all? But also what tends to happen over time is your perceived likelihood of repaying, or the amount I need to be, the reward I need to receive of taking the risk of lending you that money changes over time. And so that's something we potentially can see in markets when you might think that interest rates have fallen. Well, that's good. My bond price should go up. But actually, say credit risks have widened, actually that's bad because my bond price is then going down. And so you can get this dynamic where actually, rates have fallen, my bond price has also gone down because the credit spread's widened.
Oh, I see.
Yeah, and so you get these dynamics because they're all in play. Then the next thing to think about is duration. And so again, this is similar to that mortgage question of, okay, if I've borrowed money from the bank, and in New Zealand it's interesting because we do a lot of short-term mortgages and people often roll 1-year terms or 2-year terms. And so they're not taking a lot of duration risk, we call that. And duration risk is, look, how long am I locking away at that rate? And so offshore, you'll see 30-year terms, you'll see much longer dated bonds. New Zealand tends to be much shorter, in sort of 3 to 5 year sort of terms and maybe out to 7 years. But really what they're saying there is the longer I'm locking that money away at a set interest rate, the greater impact on the price if interest rates do change. And that makes sense, right? So if I've locked in a mortgage, and I'm sure you'll know people, and I've been in this situation where I lock away a mortgage at a set rate, and then markets change, and 2 years or a year later, I realise that I'm paying 7%, and actually I could get a new mortgage at 5%. Again, it would be lovely if I could go to the bank and say, "Hey, the market's changed. Can I now pay 5% on my mortgage instead of 7%? Yeah. Remarkably, the bank's not that keen on that.
Well, they are, but they'll charge you a massive fee for the privilege. Right?
And then that fee is the price change. And so effectively what you've done there is identified the price change in a bond, because that's all that's happening when you're selling a bond on the market. The market's looking at, okay, what's the interest rate you're paying? How's the market moved? And what do I need to change the price by to make those two things line up again? Because again, going back to that really starting point of the value of a bond as the present value of all those future cash flows, as the interest rates change, I'm just looking at, okay, what's the value of the cash flows given the interest rates today? And then that's the value. And so that's the thing that changes over time. And so that's how the duration risk plays out. And so the longer the bond is, the more cash flows you have at risk, and the more time you have of that interest rate payment to pay. And so that's, that duration risk of locking away for a longer time.
And you're therefore more sensitive to things like changes in credit risk or market interest rates.
Market interest rates certainly driving that, a lot. And credit risk, there's more time for your credit default. You've got more risk if I'm lending you money for a day. To the chances of the company disappearing in a day or not repaying in a day, should be a lot less. If I'm doing it for 10 years or 20 years, actually the chances of that company not existing or things changing that I'm not across goes up. And so there should be a premium for that. Again, that's been a really interesting dynamic in the markets over the last 10 years or so, is that risk premium in relation to longer dated has probably disappeared, but it's coming back a bit, which is where you're getting rewarded for holding those longer dated securities.
Okay, we'll touch back on the duration in a moment.
Yeah.
Just going back to the banks, right? So if you had a mortgage, you're locked in at, say, 7%, I think was your example.
Yep.
Market interest rates are 5%. You want to break out of that contract, you pay them a $30,000 break fee or whatever it might be. You're just equalizing that, like what you say. On the other side of that, though, you never get a payment if you want to sell your cheap mortgage in a high interest rate environment, which is an interesting one, isn't it?
No comment on
that. No comment on that one. Okay. Let's talk about the yield curve, because if you are an earlier, like an investor that's just doing a bit of research and you're trying to understand how things work.
Yeah.
Again, you could probably use mortgages as an example for this one as well. But what is a yield curve, and what does it mean at the moment to hear stories that the yield curve is steepening?
The yield curve is effectively essentially a table of future interest rate expectations. And so when you say the yield curve steepening, it means that interest rates for longer terms have gone up. And so there'll be a couple of things that can drive that. So one's that premium around, if assuming the curve is flat on an expectations, or you expect the interest rate to be the same, you might still need to be rewarded for having longer term securities. And so that risk premium represents as a steepening of the curve, because effectively you need to get paid more to hold those longer dated securities.
Opportunity cost, right? You're locking up that money. Yeah.
Or you get these shifts in curve where actually, things aren't looking great today, so the rates are low and they're trading, but actually now there's some green shoots in the economy, and it looks like we've got a new Reserve Bank governor in, and actually there might be some lift in rates and more inflation coming through, and a need to raise rates. And so you'll start to see that in the curve, and that'll start to see a steepening of the curve where you see those things playing out in the future.
Yeah. As a fund manager, as a business that operates a bond fund, tell me how a bond fund works, just for those that might not be familiar with that. Yeah,
look, a bond fund is, and a utilised product, and I'm sure your investors understand a managed fund or a PI, and everyone's got KiwiSaver. It's effectively where you are unitising, and all of the holdings in the fund are unitised, and everyone effectively buys a share into that fund and gets the same exposure and return. The advantage of that relative to an investor going in is, if you've got $10,000 that you want to invest in bonds, or $40,000, it's actually quite hard to get a diversified exposure or portfolio. You've got to do the research around which bonds. You've got some risk around holding a specific bond. Whereas if you go into a fund, effectively you can take that $10,000, that $40,000, and get the exposure to that full fund straight away. and that gives you a more diversified exposure. Within an active fund, you get the manager's capability and skill to add value relative to just holding a selection of all bonds. And obviously in a market which does, by its nature, turn over relatively frequently, the costs that we can buy and sell bonds for are probably less than a retail investor. And then, finally, as an active manager, we're able to take advantage of pricing anomalies in the market. When the market is, in our view, misvaluing assets, we can enter or exit. And so, coming back to that meme stock type example, where actually if people get too excited about a company and actually we think the people aren't being rewarded enough for the risk they're taking, there might be opportunities for us to add value relative than just following the herd on those securities.
Okay. What are some of the examples of how an active manager in this case would make those decisions?
Yeah.
What are they looking? What can they actually, what influence can they exercise to drive those returns?
Yeah. So look, so there's the pricing mismatch of security. So we may look at a security or, companies that operate in the same sector or, operate in the same type of capability that have bonds that have just priced differently for certain reasons, because actually there's a seller in the market who needs to sell securities, driving the price down. Actually, from a risk perspective, those securities just become mispriced relative to...
Can you just unpack that a little bit more?
Yep.
So in the New Zealand context, when you say there's an issue in the market, it might be a local council, or it might be a large bank or a corporate that are issuing bonds. If they're issuing those bonds, they're effectively saying to the market, we want to borrow a bunch of money.
Yeah, correct.
And so if they're out there and they're asking for a bunch of money, does that drive down the price of bonds because that pushes up the yields because they have to offer higher yields to get the money?
Well, it can have an interesting impact on other bonds as well, right? So if you're trying to recycle into that bond, you may need to sell other assets to then buy into that one.
Sure.
But no, I think, the concept of, what causes companies to borrow money and their different pathways is always interesting as well, because companies have different levels of, and banks, you use the example, a good example, they can get funding from term deposits, they can raise offshore funding, they can issue bonds in the New Zealand market. There's lots of different pathways for them. And so it's always a pricing question of, okay, what's the most effective source of them raising capital? And is that, their most efficient way into market as well?
Having a passive bond fund doesn't really make sense from my perspective. If you were just to hold a bunch of diversified bonds, like different durations, different varying credit risk, corporate, government, throw it all into a bucket, call it an index fund for bonds. I'm sure they exist.
They exist, yeah, no, 100%. Again, if you're looking for a diversified bond exposure for your portfolio, for a 60-40 bond portfolio, an ETF or a passive approach can do that for you.
So that is actually a thing.
It's definitely a thing. And, again, it works in a very similar way to the equity market. So around actually probably one of the challenges that bond markets or bond indexes do get, though, is obviously if they're market composition style indexes, the person issuing the most debt has the largest exposure to the index. Right. As opposed to being on a share market one where the highest value company has the biggest proportion of the debt. In a bond market, it tends to work to every the person who issues the most debt. Right. And so you can take a view of whether that's a good thing or a bad thing. It might just represent that it's the largest company, but it could also represent that it's the largest risk exposure.
Interesting.
I think one of the other interesting things, and we sort of talk about the meme stocks and these growth companies, and could that play into the bond market? It absolutely could, right? If you get a company that's incredibly popular that says, actually, everyone loves us. We're going to issue debt to people and we're going to buy Bitcoin with it. Actually,
what a crazy concept.
What a crazy idea.
Who would ever do that?
You get a concept where you actually now you've got a security where they're issuing debt, a bond, and doing something which is popular. And so they're able to issue that debt. People are buying it. And you may take a view or not of whether that's a good long-term idea. But, you've got that position where you've essentially utilized a popularity to drive an outcome, which is different to, say, the fundamentals of the business or the fundamentals of security. And so, again, similar things can happen within the bond market as well, and across countries. And, because the bond market applies at lots of different levels. And, we've touched a bit earlier of, companies, local government, private credit. There's all these different types of credit markets that exist, from your kind of risk-free assets and US type government bonds being considered a risk-free asset, through to private credit and the other end of the lending spectrum.
Yeah. Zooming out then, thinking globally, we had a real interesting live case study with Japan recently. And again, another podcast right there, but we saw a spike in 30, 40-year Japanese bond yields. I think record highs. I could be wrong, but record highs. And that has flow-on effects. Like the Japanese carry trade is one of the first ones that I think of. And just thinking about Japan as being one of the sources of global liquidity, especially if you're investing in the US, cheap Japanese money is one of the reasons why the market might be where it is. So your summary of what's happening in Japan right now, though, just because it's probably better than mine, and how does it actually affect us as investors if the Japanese yields spike?
Yeah, look, I think that once you get the essentially the adjustment to that narrative of these will be zero forever changing, I think we'll get a resettlement. Absolutely, that initial spike will change, and you kind of almost view it, and you'll probably remember the taper tantrums from the US when actually, as soon as rates lifted in a tiny amount, equity markets would completely disappear. Completely freak out. And, labeled a taper tantrum because effectively it was the equity markets in a tantrum state of a fear of increased rates. To the counterpoint, though, increased rates are a signal that actually the economy might be growing, there's potentially a bit of inflation in there, that actually things are going to be going better. And so you get this weird dynamic where we're saying, well, actually, those increased rates are a sign that there's some stability in the economy, there's strength, they're not having to cut to stimulate. And so the Japan story, on one side, there's a positive news to that side, to that story. On the other side, though, there's that initial adjustment of things like the carry trade, the excess supply and liquidity that's been in the market. And as those things adjust, you get some short-term noise that you see in the market, which is what we've been seeing.
If we think about central banks around the world, they hold reserves, and there's rules that govern what these reserves are and what proportion, all that sort of stuff. And U.S. Treasuries have been reserves for central banks. But reclassification of gold as a tier 1 reserve asset has resulted in rebalancing occurring with a lot of these central banks, where instead of gobbling up treasuries, increasingly the banks have decided to gobble up more gold rather than these treasuries. And so, again, kind of like what we're talking about with the Japanese yen carry trade unwind, potentially, maybe it's another equalizing force. But when central banks are buying more gold than treasuries, that lower level of demand for treasuries presumably would increase yields as well. Would that be correct?
Yeah, look, and it's that very similar play out, I think, in story. Of there's a readjustment there, as you've seen your gold price move. I think I couldn't tell the price today because there was obviously a bit of a reversion a couple of days ago. But again, 6 months ago, I don't know if we would have been talking about silver either. So
that's right.
Again, you look at some of these markets, and there's been some flight. You do go back to actually what are some of those core things that drive US Treasuries as a safe haven asset. The strength of the US economy, the strength of the US government, actually the independence of the Fed. And whilst those things come under pressure and there's noise from time to time, that's where you'll see the price movement changes. But actually has that fundamental shift change. And I think the US is a great example because historically, holding a US Treasury, you had a strong US currency, which was the reserve currency of the world. You had a US government bond, which was risk-free. Things were great. There were never any issues with that approach. That's changed. And, I think in the past we've seen and certainly had conversations, not with you, Darcy, but with others around, is the euro replacing the US dollar as the reserve currency of the world? Is that going to be another currency in the future? It'll come up again. And those things will change and the markets will adjust over time. So, look, I think, again, similarly, I think it'd be far too early to call the end of US Treasury dominance as a reserve currency of the world. They take a lot longer. And I think what you tend to see, though, with markets is those adjustments to those little micro changes or potential long-term macro changes make sharp adjustments in markets because people are always in markets as efficient. If you're an efficient markets believer, they're pricing in all of those future expectations today.
Got it. All known information.
All known information straight away. As an active manager, we don't think that's a perfect process. And so that's where we add value because sometimes people are wrong.
And so just think about those central bankers versus us, obviously slightly different scale, right? But if central banks are reallocating more towards gold, not necessarily dumping treasuries, but just gobbling up gold as they have been in record amounts, we have seen the gold price obviously move significantly And that will, for a huge segment of the retail investing squad, that will be a trigger. Maybe we should get in on the action as well. But just as it relates to how people construct their own portfolios, do you see that everyday investors might naturally start to, or even fund managers might naturally start to include more substitutes for bonds generally, not just treasuries, but just bonds generally, in favor of precious metals? I know they're not comparable. There's no income from it,
Yeah.
but there is kind of like an interesting dynamic that happens, right?
Yeah, look, and I won't go into gold price speculation or precious metal speculation for you, but there's certainly better place to talk about that. But that concept of replacing US Treasuries within your bond portfolio, look, there's lots of options for that, and there's lots of diversifiers into a balanced portfolio, and so that classic balanced portfolio of listed equities and some government bonds is actually not probably what your portfolios look like on a day-to-day basis now. If you're in KiwiSave or you're receiving financial advice, there'll be other assets in there. There's infrastructure. You'll start to see more and more unlisted assets. So that can be private credit, it can be private equity.
Sure.
Starting to see other diversifiers. Look, and you'll see gold in portfolios. That is happening. And there's KiwiSave providers where that is happening, and KiwiSave providers where you can be selecting into that.
Yeah.
I think the market dynamics of gold and we talk about silver as actually those things have moved. Price movement can create more price movement as you get people following that herd. Exactly how much of that is a reweight of treasuries being put into and central banks buying gold versus how much is retail excitement as you've seen Bitcoin price come down, moving into gold. You're seeing, is that a reallocation of risk from a different part? And so, look, that's one of the hard things about market. You kind of don't know if a bumblebee sneezed in Japan and suddenly we've got a different crisis somewhere else. But again, there's always a lot of moving factors in these, and I think that the challenge is always trying to sort of sort through the noise and what are those long-term thematics. But if you're thinking about managing a portfolio, we would never recommend trying to assuming that you have perfect insight as to where things are going. The reason similarly for holding bonds in portfolio when you have an expectation that equities are going to return more is actually that defensive nature and that offset, because you're not always right. And you got to understand how much risk you can take, how much risk you are taking. Make sure you got the balance in the portfolio to allow for that.
Yeah, I think it's good. Strategy always trumps your ability to see through the glass dimly, right? No one sees perfect information, right?
No, and look, and because events happen as well, and so I think that's that's always the real challenge. And you look at gold, and gold's a classic where you essentially could have endogenous shock or a shock positively or negatively. And so we often use terms like volatility or shock in a negative way, but actually shocks can be positive. Something could happen, and wars are a great example. Gold looks good in those scenarios. Actually, the other thing is another shock could be actually world peace looks really good again. And then, that seems a bit of an unwind, a bit of a risk on trade, a bit of a flight away from those, sort of precious metals defensive, and the price moves the other way. And so those things can all play out in market. And it's a really interesting dynamic.
It is,
which is why I love doing what I do.
I know. You could interpret the data differently depending on where you're at in the cycle of that story unfolding as well.
Yeah. Oh, look, and I think, that's why markets trade every day and markets work, is because that's essentially a presentation of, different views. Every time I'm buying something, someone's selling it. And so actually what you're seeing is that person who I'm selling it to must think that the price they're selling is the right price, and I must think it's the right price. We must have a different view of where it's going next, because the seller's not selling it if they know it's going up tomorrow, unless
they need the money.
Desperately need the money. But again, the concept is that they just have a different view of what happens next than I do. And it's that difference is how markets work. I think it's really interesting you talk about the sort of price decline in housing. The difference with bonds and equities to a degree and gold is they're things that price every day. That fall in property prices, you see, no one comes and knocks on your door every day and tells you their house price that day. Whereas if you buy gold, you see it on the news every night. You can check straight away 24/7 what the price is. Whereas that doesn't happen with some of those other assets.
Yeah, I hear you. Thinking back to New Zealand then, when we think about the entities that are actually borrowing, issuing these bonds, we'll have a mixture of corporate and government, maybe local council, large corporates and stuff like that. When you think about where the repayments come from, or just thinking more deeply about the credit risk itself, New Zealand is obviously a very nuanced economy
Yep.
relative to, say, the US, for example, very, very different. Do we have like a narrower range of, I don't know how to say this or ask this question, to be honest, but it kind of feels like the credit risk that we take here is it's over a narrower band of businesses and entities that we're lending to, because in the US we might be lending to steel manufacturing or shoe manufacturing or restaurants,
Yeah.
right? Whereas in New Zealand, what's it going to be? It's going to be what, banking, forestry, property. I don't know.
Yeah, like, and you look at the composition of the New Zealand market. The LGFA, so the Local Government Funding Authority, makes up a huge portion of that, the bonds issued in the New Zealand market,
Yeah.
which is lending to councils. So again, you look at where that all councils or local government entities who fund through that source. You know, how do those get repaid? Well, actually through your rates, and so again, from credit quality, that feels pretty good. I can lift your rates, and I've got a clear pathway. Banking is obviously another source of a lot of the bond issuances in New Zealand. Again, I understand how that works. So, probably borrowing that money to buy the house.
And I guess in a way, because of the monopolistic nature of so much of New Zealand's entities, because we're so small, you in a way have lower credit risk, right? Because just thinking about the council, they'll just increase the rates. Banks, who are you going to choose?
Right? Yeah, and so you look at it, but I think it's actually a really valid point, and you look at the sweep or the range of entities being lent to in New Zealand. It is smaller than the US. I mean, the US is a much deeper market, and it's interesting because in that much deeper market, though, things like credit risk actually become a bit heightened, because actually there's a reasonable chance that there's more issuers who are going to go under and default. Right. And effectively, as you think of credit risk, actually credit risk is, am I going to get repaid? It tends to play out in New Zealand as the perception of my credit quality or risk going up or down over time. But actually, at an extreme example, there's been companies in New Zealand where bond prices have moved significantly over time, because actually their likelihood of existing as an entity has gone down over time, and so hence the value that you put on holding a bond that has a future repayment date goes down. And so as you look to periods where companies may be close to having to recapitalize or refinance, and these refinance cliffs, you can see some quite significant movements in bond prices during those periods. And so bonds are at a base level or a risk-free level, sort of micro adjustments and micro sensitivities. But you can see some really extreme events in the edge cases. As you think of things like default of buying a bond in a company that's potentially going to go under. You're taking a really big risk bet on that position, and you're moving away from that being that defensive income producing asset within your portfolio, being a lot more speculative. But that is a part of the bond universe and world. Your high
you often
yield,
look at it as low risk, right? But it can actually
doesn't have to be. It doesn't have to be. You go into high yield distressed debt type situations. Junk bonds. That's the market. And again, those things around credit, credit risk and understanding are much, much more important. Because actually, the chances of not getting repaid do go up.
And so obviously there's a lot of stuff happening in the world right now. Like, I can kind of vaguely understand some parts of it. We have stable coins being backed by U.S. treasuries. We have a new potential Federal Reserve chair in the form of Kevin Warsh. Is he going to be a yes man? Is he going to be a hawkish man? Time will tell. Here in New Zealand, we have a new Reserve Bank governor. Will she be more of a dove or a hawk? I don't know. We have the Japanese rising interest rates, rising geopolitical risk. And then we have New Zealand, which seems to be more advanced in a way in terms of the interest rate cycle relative to Australia, question mark on the US, of course, and other parts of the world where maybe rates start coming down. Who knows? Like, I have more of an optimistic take there than many. Like, putting all that together, how should an everyday investor actually think about allocating to bonds right now?
Look, I think your first decision is that stepping back up and understanding the amount of risk and the overall risk you're trying to take in your portfolio. And we talk about that classic 60-40 fund, but actually, what is the role of bonds and talk about bonds being the 40, but bonds and cash, and what are those diversifiers that you've got in your portfolio? Getting to understand how that plays out. Look, absolutely understanding the dynamics that impact on bonds and bond prices is helpful. Understanding what you're getting when you add a bond fund into the portfolio is super helpful. What's the role it's playing for you? But that first step is always sort of stepping back and trying to understand what you're trying to achieve with your portfolio. and then actually what are the building blocks and what are the pieces of the puzzle I need to bring into play to get me those outcomes. And so thinking about, okay, as I understand my equity positions, I hold on to that. Okay, how does the diversification of bonds support that? And then what's the best way to achieve that? And look, there's different approaches. You go buy them yourself. You can, go into the ETFs. You can go passive. You can come to an active manager. And it's really about making sure that the thing that you're selecting into that portfolio meets the requirements of what you're trying to achieve.
And I guess so, like from an active manager's perspective, I guess there's one aspect of this where you could say, right, well, my objective here is to maximize returns. But at the same time, you have to think about the investor as well, right? Like how much volatility can they handle? What are they expecting as a product that we're actually delivering to the market?
Yeah.
How does a fund manager actually balance that tension between kind of taking these geopolitical or macro factors into account versus delivering a financial product that investors feel good about putting money towards?
Yeah, look, and the real key for that is having a product that's designed, to achieve an outcome, and be really clear with investors of what that outcome looks like. Understanding around the expectations of what the product's there to do, and then delivering to that. And so again, that's just making sure we're not taking too much risk within the portfolios, that we're being adequately rewarded for the risk we do take within the portfolios, and just making sure that we're managing, in line with what it says on the tin. Because I think, there are lots of different options. And actually, within the Harbour business, we have lots of different options around how we invest on behalf of our underlying clients, and a lot of funds that you can achieve different things. Key thing is, though, that what we say we're going to do, we deliver to.
Got it. And then lastly, bit of a spicier question. The risk of a currency reset is something that I've covered with a lot of other guests from many different perspectives. Some would say this is a US only problem. Others would say it's a global problem because of the connectivity.
Yep.
And then because it'll happen amongst so many other things, if the currency was to reset, then it kind of will all equalize out for a lot of different factors, maybe. But if we were holding a bond and we were relying on the constant income stream coming back and the return of our capital, we can kind of assess it within the paradigms that we've discussed here. But if that actual substance, that currency that we're getting paid back in, is no longer the currency that is being used in circulation because we've locked in a 5-year bond and then 2 years from now, currency reset, how does that affect the bond market?
Yeah, it's an impact, right? I mean, and so currency is a classic within a bond portfolio. And what you'll tend to find with bonds, and global bonds certainly, is most people are hedging out that currency risk. Because effectively what you want with the bond is you want that income stream to effectively return as it's meant to, rather than getting whipsawed around by the currency movements over the time. So again, you think about that, a revaluation or reset of currency, and essentially a step change of currency value. And again, depending on what it's trying to achieve, essentially a reset down and improving, for exporters is around actually, just a complete devaluation will change the impact, for an investor.
Yeah. And I guess like if we're thinking about this in the New Zealand, because you guys operate a bond fund, and for full disclosure, we use as an advisor, we use the Harbour Fixed Interest Fund here. And in our local currency, you don't have to worry about hedging, do you?
No, but we do. We do obviously run a global bond fund as well.
Of course. Okay. So in that one.
Obviously, and in that one. Yeah. But so we 100% hedge. And look, the reason for that and why bonds are traditionally 100% hedged is you are looking for those defensive characteristics of the income, the return of capital, and essentially having that currency risk, the volatility of the currency risk can tend to outweigh the defensive characteristics of the bond portfolio. Yeah. So it's no longer achieving what you were trying to achieve. Yeah. And again, back to that statement around, look, make sure you got the building blocks put in place that are there to achieve what you're trying to achieve.
Yes.
Having an unhedged sort of bond position, given how much the currency can move around, is a tough position for a New Zealand investor position. Obviously, New Zealand bond fund, not an issue. You're getting paid back in New Zealand dollars. You live in New Zealand at all. But global fund is a different story. Yeah. So again, you think of that individual who's going out to buy bonds. If you're going out to buy US treasuries by yourself, hedging's a lot more difficult.
Yeah. So if people want to actually get exposure to any of Harbour's products, obviously I'm going to say this because I'm a financial advisor, talk to your financial advisor. What's the website that people can go to learn more?
Yeah, so it's harbourasset.co.nz. And the other great thing on the website is that we've got a lot of information and reports and commentary that our experts write on a regular basis. So if you want to read more about what's going on in the markets, it's a great place to get more information as well.
Fantastic. Thank you again, Chris. Really appreciate your time.
Wonderful. Thanks for having me, Darcy. Cheers.
Special thank you to our show partners who help make this possible. Thank you so much, you're awesome. SwiftX and Provincia, thank you again. Want to connect on social media? You can find me on X and you can find me on LinkedIn. Remember, some investment strategies or ideas can make you obscenely wealthy or wipe you out completely. It's hard to know from this and what's best for your world. So if you can, reach out for some advice that accounts for your own circumstances. That's it for this one. Catch you next time. I'm out.